Okay.
So good morning, everybody. Bob and Christina, and Coffee with Bob today, broadcasting from my office. We're going to talk about the election, the markets, and what it means for you.
That's right. Thank you again, everybody, for tuning in this morning to the latest episode of Coffee with Bob. We are back together for a live episode. It's been a minute since we've been doing this together, so we're excited to be back. For those of you who are tuning in for the first time, Coffee with Bob is a mini webinar series brought to you every other Wednesday morning at 11 a.m. We cover timely topics. But before we get started, just wanted to say a huge thank you. There are a lot of you who tune in episode after episode, week after week, and we really appreciate it. What that tells us is that you like what you see, you like what you hear, and we're going to keep bringing this to you guys. But that being said, please do pass this along. We don't want to keep this a secret. The more the merrier. We're trying to grow this thing. We want to reach as many people as possible. We're going to be bringing a lot of great content your way, not just covering the markets and personal finance, but a lot of different topics that we think you guys are really going to like. So if you see an episode that you think a friend or family member would be interested in, send them the link. Like I said, the more the merrier. So we have our cups of coffee, and well, this is tea, full disclosure, but they're both H&A mugs. So we're representing the team here today. As Bob said, we're going to be covering all things election and the markets, and most importantly, what it means for you. We're going to be taking questions at the end. So as we go through this presentation, if you think of a question, you don't need to wait until the end to submit your question. Use that Q&A box. It's either going to be at the top or bottom of your screen, and we're going to be taking some questions live at the end of this presentation. So we are basing this presentation off of the three most popular questions that we get from you guys, and they're right here on the screen. The first, how does the election affect the markets? Number two, how should I change my investment strategy in anticipation of the upcoming election and its results? And number three, what kind of strategies can I use leading up to and after the election? These are all fantastic questions. Again, the election is a topic that comes up in conversation every single phone call meeting that we've been having with our clients, and rightfully so. It's a huge deal. So let's get into how we like to talk to these questions here. And we think this is going to be some really helpful information. So first question, Bob, how does the election affect the markets?
Okay, so when there's uncertainty, and there certainly is uncertainty surrounding the elections coming up this year, there's a lot riding on the results. And because of that uncertainty, it creates volatility, right? There's buyers or sellers, depending upon what they think is going to happen. And that affects the markets. And so that creates volatility. And of course, we at H&A love to use volatility to your advantage. We attempt to do that every single day. And but it is typical of an election year that that you will have some additional volatility that can occur.
Mm-hmm.
And you should know that when a new president is elected, usually there's lower market performance. If the incumbent wins, it's usually higher market performance. So all these bullet points are relevant. And pre-election years, because the administration is doing everything they can to support the economy, support the markets, they're using all the tools in the tool bag. We expect to have good returns this year.
Yeah, all of these little facts that you see here on the screen, typically higher volatility associated with an election year, or that pre-election year is usually associated with higher market returns. This is based off of historical data. It doesn't necessarily mean it's going to happen, this election cycle or the next election cycles to come, especially considering right now when everything is, there's a lot of unknown that we are facing given everything that's happening in the world. But at the very least, these are some pretty cool facts that you can use at your next cocktail party, even, whenever that may be. But there is some weight to what we see here. And so these are trends that we do pay attention to when we talk amongst ourselves within the investment committee and, with our clients. But we let the markets tell us what to do rather than putting complete faith into these facts. So we have one more cool fact for you, and it has to do with the markets essentially being able to, tell the future in a sense. Bob, do you want to talk about the 3-month rule?
It's really, if the market's like the president, they're predicting, they're pretty accurate, pretty darn accurate at predicting the winner of the election. You see that by market performance, the income. If the market's up for the next 3 months, August, September, October, that usually means the incumbent's going to win. If not, then the challenger is going to win. So the markets are pretty good at forecasting who the next president is going to be, and just like they forecast economic conditions. Yeah. The markets are usually very anticipatory in those regards, in both of those things.
Yeah, I mean, talk about another cocktail party icebreaker at the very least. Since 1928, the stock market has accurately predicted the winner of the general election 87% of the time, and 100% of the time since 1984. It's pretty cool. Now, that being said, should we look to this sort of fact when, we're trying to figure out what's going to happen this November? Not necessarily, just because of everything, again, that's happening. These are unprecedented times, but it could be a good clue as to where things are going. We just don't know, but this is a pretty cool fact for you to have in your hip pocket. Okay, so let's talk about this next question. How should I change my investment strategy in anticipation of the election? It's a great question. It's one that we get a lot of the time, but I think we would argue that before asking this question, maybe we should be asking, should I change my investment strategy in anticipation of the election? Bob, do you want to speak to that?
Yep, that's really the right question, Chris. And chances are, if you're working with H&A, you have articulated your unique plan to us. We've maybe helped you craft that plan, whether it's orally or it's written down, but we have done that with you, and we understand it. And your investments, the investment program that is implemented for you is designed for you. It's designed to be for the intermediate and long term, and that way you have the greatest chance of success. So we like to focus on the intermediate and long term, and we understand that there is volatility, there can be volatility, and there can be changes. If Trump doesn't win and the Democrats take control, there couldn't be changes to tax code, et cetera, and there could be other changes. But in any event, your plan has been designed for the intermediate and longer term, and chances are you don't need to change it. Now, last thing in the world we want to have anybody do is lose sleep over their investment. So we should talk about those things that affect you. But keep in mind that through any market cycle, if a market cycle is 4 years, we expect to have 3 positive years with the stock market, maybe 1 negative year. Everything averages historically around 10%. Don't see any reason why that isn't going to continue into the future in the typical 4-year cycle. So, we want to manage the volatility. We want to manage when things fluctuate. And so we, again, manage the things that we can control, and we can control your allocations. We can control rebalancing your portfolio, and we can control reallocating. There's some other things we can control. We'll talk about that here in a little bit.
Yeah, absolutely. We will get to that in just a minute. On the slide here, for those of you who are tuning in through the video and not just calling in, you can see some considerations that we like everyone to keep in mind, but I want to highlight one important thing. Returns in your portfolio are made over business cycles. It's a long-term game. Business cycles are longer than election cycles. So that's why we can't stress enough, a well thought out, a well executed plan stands the test of time. It withstands any sort of volatility that could happen from an election, from a pandemic, from a terrorist attack, from all of these different, crazy things that can be happening in this world today. Your portfolio is built to withstand and even persevere through those bouts of volatility, through those bouts of uncertainty. So it's really important to keep that long-term mindset when, talking about your investment game plan. So let's talk about one more aspect of this. Again, here's just an example of why just because one person or another wins the election, it doesn't mean that you should do a complete overhaul of your investment game plan. Typically, a Democratic president or Democrats having control of Congress are typically associated with higher tax rates or maybe less than friendly business policies. And therefore, yes, it is expected that if a Democrat were to be in the White House, that taxes we'll see a hike in taxes. Does that necessarily mean that the markets are going to tank and take a dive? No, not necessarily. What you're looking at here, this chart shows a history of the S&P 500 returns for every year that a Democratic president has been in the White House since the 1950s. And what you can see is it's an overwhelmingly green picture. So again, just because one person or another wins the election does not mean that we should be jumping to conclusions and doing a complete overhaul of the underlying fundamentals that have built our investment game plan. Keep it long-term, keep that long-term mindset. Okay, let's talk about this next question. So again, we can't control what happens in the world and how that affects the markets and how that affects the volatility that we see within the markets. What we can control is how we react to that volatility. And there are strategies that we believe you can use to use that volatility to your advantage, as Bob was alluding to a few minutes ago. So we're going to get into a little more detail as to just some of the many strategies that you can take advantage of, not just within your portfolio, but within income planning and estate planning. So let's get into these categories. We broke them down into three main categories. Starting with investment strategies. Bob, do you want to speak to this?
Sure. So, when I think of our clients and I think of the taxes that they pay and things that they need to consider, I think of, before I get into investment strategy in particular, but it's all related, I think of the taxes that our typical client is paying. It could be income tax on wages, right? It is definitely taxes on interest in dividends that they earn in their portfolio. It's definitely could be estate taxes upon death that your portfolio would pay and your children would pay or your beneficiaries or heirs would pay. So, those are all things that we consider. And so I'm sort of working in here because it all works together. And so investment strategies, we don't know what's going to happen early November with the elections, but if there is a change in the White House, then we may want to consider harvesting gains this year prior to any tax hikes that might be anticipated because of a change in the White House. So those are things that we can think about. Harvest losses to offset gains in high tax years. Should there not be a change, we might want to, should there be a change, we might want to consider taking losses in a high tax year to offset gains. So these are things that we can talk about. These are planning issues. I can tell you that if there are changes in the White House, we're going to be really busy working with you, working with your CPA, working with your attorneys in November and December to make sure that there aren't any stones unturned regarding all these things. We're very tax sensitive. I'm proud to pay taxes, don't want to pay a nickel more than I have to. So we are very tax sensitive here at H&A. And we structure portfolios to be very tax aware. We want you to control when you pay taxes, not somebody in New York or Los Angeles, some money manager there. We want to control. So we have set up your portfolios that you get to control when you pay taxes, and we communicate that with you. So therefore we can plan around paying taxes, and that's a better way to do business, we think.
Yeah, and Bob, these strategies here are not meant to just be used in anticipation of a tax rate hike.
Right.
Is that correct? I mean,
correct.
We use these strategies.
Regular course of business.
Exactly. But that being said, if there is some sort of legislation that we are foreseeing or that you are foreseeing, it's always a good idea to review these strategies with your advisor and make sure that you're doing everything you possibly can to prepare for any sort of changes that would affect your finances in your portfolio.
Yep.
Okay, so let's get into this next category, income recognition and planning strategies.
Very simply, you want to try to pay taxes in the year where you have the lowest tax rate. So again, if we think there's a change in the White House, change in Congress, whatever it might be, where taxes may be going up sooner rather than later, then you might want to accelerate income into this year or take gains this year, consider those things. So again, we'll know that after the elections, we'll know where we stand because the Democrats have broadcast their policies. Trump and the Republicans have sort of broadcast their anticipated policies. So if we know what the rules are, then we know what courses of action to recommend for you to consider. And this last bullet point, I remember David Tepper, they named the Tepper Business School after him here at Carnegie Mellon at CMU, and he changed his residency from New Jersey to Florida a couple of years ago, and New Jersey had to relook at their budget for the year because he was paying so much in state taxes. So this, this is actually Florida. There's no tax on income, so people change their residency to Florida, save a lot of money. Now things in Florida tend to cost more, but they at least save on the taxes in that regard, on the state income taxes, by staying out of their original state for 6 months of the day.
Yeah.
So,
yeah, this strategy, moving to, maybe a more tax efficient state in terms of state income taxes, it's an even more realistic and doable strategy for more people now more than ever because of our embracing of technology and being able to work remotely. So, hey, that might be a strategy for you or someone you know. What we recommend though is whether it's accelerating your income or deciding whether you want to domicile in another state, work with your advisor, work with your CPA as well, and your estate planning attorney. Make sure that that's the right move for you. Again, these are just some of the many income recognition strategies that we're looking at. So, there could be a way for you to get creative, work with your attorney, work with your team of advisors, and see if there's something that, again, can work for you, work for your family, and work for your business too. Okay, let's get to this last category, estate planning strategies. Why don't we first talk about the current tax laws, how they're set to sunset in 2026, and what that means.
So the current administration pressed forward with some tax relief, right, a couple of years ago, and those policies are in place now. Congress approved those as temporary reductions in tax rates, and they're due to sunset or revert. In other words, revert back to their old rates in 6 years, right, in 2026. So, yeah, I mean, that's, so all the planning that we've been doing for the last couple of years could change unless there's an act of Congress to make those permanent, and that could happen, but we won't know till then. Now, if there's a change in the White House here in November, if the Democrats have control, I think we could see some acceleration of these going back to previous rates or even different rates for inheritance taxes, income taxes, taxes on capital gains. All those things could change. And if they do, we'll be working with your tax advisor, with your tax advisors, to line up the ducks for you so that we can minimize taxes as much as possible.
Okay. All right. So why don't we get into, why don't you pick out a couple of these specific strategies here that stand out to you? Yeah,
I mean, so deferred deductions, one of the things we've been advocating is that because of the current tax laws, it really makes it much more efficient to get a charitable deduction if you sort of pile all your deductions into 1 year instead of spreading them out over 2 or 3 years, because then you reach the thresholds for being able to deduct those. So that's one strategy you could consider. So if you're, for example, if you give to your church, they may not like it, but if you give your charitable deductions to the church all in 1 year instead of spreading it out over 2 or 3 years, they're going to get the same amount of money. They'll get in a bigger lump sum, and you'll be able to deduct that. So potentially we deduct it. We need to talk to your CPA, make sure the amount that you're considering would pass that threshold. So, deferred deductions, give less this year, give more in future years, same thing. Whether you do it in stock or cash, same thing. Taking gains in anticipation of a change in the step up at death. Then we might want to accelerate gains into this year rather than future years. So these are all things that we can talk about. Once we know what the rules are, once we know who's going to be in control and setting policy, then we can relay that information to you. We'll work with your advisors on implementing any strategies that you want to implement in your portfolios.
Right, that's absolutely right. We can't stress enough, these are based off of what is anticipated to happen if changes in the tax laws were to occur. And some of these are based off of pretty specific, components of a potential new tax law, but we're not going to know exactly what that game plan should be until we actually see who gets elected into the White House come November. And once we actually get a better idea of what that new legislation is going to look like. So it's always great to have these conversations, start having these conversations now, so that by the time it's actually time to act, you have that strong game plan in place and you can move efficiently. All right, so
we don't want to alarm. We just want to inform you that there could be some changes and that we're thinking about them. We're on it. We're on it right now, so that we can speak with you and help educate you about what your options are.
Perfect. Okay, so we that's it for the presentation, and we have some questions that were already submitted. So we're going to get to those, and as you have any questions, please do submit them. Okay, so the first, what are the current estate tax exemptions versus what they were previously?
So everything's going to revert back, possibly back to roughly 5 million indexed for inflation for the federal inheritance tax. So each living person gets a $5 million exemption. In other words, a husband and wife get a total of 10 million. If you do your planning properly, you can take advantage of that full 10 million. Currently, it's 20 to almost $23 million that's exempt from federal inheritance tax. So keep in mind that doesn't affect state income tax. So it's the Pennsylvania state income tax is as low as 4.5% for assets moving within family members, immediate family members, and then could be as high as 15%. So there's some planning that can be done around those also. So depending upon what you want to do through your will, through trusts, etc., through your listed beneficiaries, there are some things you can do to maybe tweak those and reduce taxes.
Yep. All right. Great question. Okay. Next question. How soon should we expect tax hikes to happen?
Tell me what happens in early November, right? So once we know who wins the elections in Congress and in the White House, then we'll have a pretty good idea of what their policies are, because they've been sort of telegraphing those now. We'll have a fairly good idea. We can start working, putting concepts by you and in front of you for your consideration. And what they'll cost. Yeah,
it's definitely not a matter, I think it's safe to say it's definitely not a matter of if it's going to happen, it's more a matter of when. Could it be as soon as next year? Could it be, not until 2026? Could it be somewhere in between? We don't know yet. So we'll have to stay tuned. Okay, next question. I just retired and am depending on my accounts for income. I'm worried about what the markets will do depending on how the election goes. Should I make changes to my account ahead of time to limit the chances of my account going down?
So keep in mind that here at H&A, our policy is to understand your unique goals and needs and implement your portfolio accordingly. So the benchmark, it's you, right? So everything we do in your portfolio is built around you and implementing to meet your unique needs and goals. And so if we've done that correctly and we're in good communication with you, then chances are you don't need to make any changes. Yeah. If you feel like something is changing, there's like one of those life events that may affect your game plan, then talk to your advisor, make a phone call, schedule a meeting, whatever it is, and communicate that so we can make the adjustments.
And just to be clear, when we talk about life events, we talk about events that directly affect you personally and specifically in your family. So, for example, one of those major ones is retirement or divorce or, an inheritance. Those sorts of things can sometimes result in that, change in those underlying fundamentals. But, when it does come to an election and its results, typically our thoughts are that does not, necessarily mean that an overhaul should be done to your investment strategy. Okay, a great question though. Okay, we have another one and it's similar in nature. So if you've seen gains in your portfolio, do you recommend the strategy of protecting your gains by moving some of the gains to bond funds, especially if you are concerned about a crash or decline in the market after the election?
So Tony, thanks for the question and thanks for using the Q&A box, appreciate that. And so you should talk with your advisor. At H&A, when we're managing portfolios, we are constantly looking at trimming or adding at the margins, right? So we have target weightings in your portfolio that are, again, based around you. You're the benchmark. So in your risk tolerance, your needs for income, growth, et cetera, in your portfolio. And we're going to be automatically looking at those weightings and trimming or adding at the margins almost automatically. With the vast majority of our clients, we're going to do that automatically. With a couple of clients, we're going to make a phone call for you first to get your permission to do that. But for the vast majority of our clients, we're going to be managing that process of trimming at the margins or adding at the margins and therefore doing exactly what you're talking about, reducing risk and protecting some of the gains.
Right. So, just to more specifically answer his question, does our investment committee see any particular reason to maybe do that before or after, right after the election?
Yeah, so we try to think intermediate, longer term. It's if we did see something that was crystal clear to us, and that rarely happens, we would make some other changes in your portfolio. But chances are, we're thinking we're going to continue to stay in the game plan of thinking intermediate to longer term. It's the best way of lining the ducks up, so to speak, of you achieving success in your portfolio is by thinking intermediate to longer term.
All right. Okay, so I see a couple of you may have raised your hand, and if you have a question, we do need you to submit that through the Q&A box. So we'll just give it another few seconds, or for you to.
Or you can always we can reach out to you, or you can shoot us an email or a phone call, and we'll answer your questions.
Yeah, absolutely.
Why don't we hit that Q&A box one more time, see if it refreshed? Nope. Okay.
No, yeah. Okay, so we'll leave it at that. And as Bob said, if you do have any other questions, please do reach out to us. Use us as that resource. Our number is 412-261-5966. Our emails are at the bottom of this screen. And we hope you do reach out to us if you think of any other questions or want to talk any of these strategies through and see if they work for you and your family. And we'll see you in a couple weeks. 2 weeks from today, we are covering active funds versus passive funds and the importance of both of those in your portfolio and how they complement each other. So we're going to get to that in 2 weeks. But in the meantime, please do use this as a resource, and we'll see you then. Thanks very much for tuning in. Take care.